Our home price is going to fall as much as 20% this year. According to Canada's banking regulator, it's very possible. That's what we're going to talk about today. My name is John Pisalis, president at Realosophy Realty. Get all my latest writings at movesmartly.com. If you find this video helpful, please hit the like button and subscribe to stay up to date on all my latest videos. So the head of OSFI, which is Canada's banking regulator, came out this month and basically said that there's a chance that once interest rates increase, this speculative fever, he called it, in the housing market is going to cool down, and some markets that saw rapid price growth might see a 10 to 20% decline. Now, it's very interesting because this is a very shift in tone from what he had a couple of months ago. A couple of months ago, he's on BNN, asked about a surge in investor demand kind of coming into the housing market. The Bank of Canada had raised concerns about that. And his response was very positive. I mean, his response was all the power to the speculators investing in the housing market. It's a free market. So obviously now his kind of tone has shifted a little bit. Of course, when you have too much speculative demand, I mean, it pushes home prices up a little bit higher than they otherwise would be. And that's kind of what we're seeing today. So I think it's a good shift in messaging from our banking regulator. But how likely is it for us to see prices fall 20%? I mean, to be frank with you, it's probably highly likely, especially in many of these smaller towns where house prices are exploding, 50% year over year. Downtown Toronto markets and prices are not going up that high. And usually the markets that are more vulnerable are the ones that have seen a rapid price growth. So I think it's possible for that to happen and maybe even likely over the next little while, but probably not this year. I don't think we're going to see any big downward pressure in prices. I mean, I've kind of talked about this in previous videos, but I think there's still a lot of momentum. I think we'll probably by the second half of this year see the housing market cool down, partly through buyer fatigue, partly through higher rates. But again, the housing market needs to kind of, go into sort of cruise control. We need to stop seeing prices rise before we see prices fall. So my instinct is, and again, it's obviously tough to predict these things, but we'll probably see the housing market kind of ease up this year. And then where things go, after this year, obviously is very tough to predict. And even if we say it's high risk in some of these smaller markets, the reality is, I mean, we don't know. We've never really seen this type of dynamic where people are just leaving cities for smaller markets, for affordability reasons. And the one thing that makes it hard to predict, even though we might say it's higher risk because they went up so high, the reality is these markets are driven by end users and families who are living there. So, are they necessarily going to sit there and fire sale their homes tomorrow? Probably not. So, there are some sort of arguments to say that maybe even though it's higher risk, we might not see this sort of same type of downturn we typically see in typical speculative housing markets, where a lot of the demand is driven by investors, because in those markets, it's predominantly end users driving prices. So again, we're kind of in uncharted waters here. It'll be very interesting and I think important to track some of these dynamics as they unfold over the next year and a half, to better understand specifically what segments of the market are vulnerable, because a lot of the data and a lot of the trends impacting today's market are new and different from historical booms in housing prices. If you have any questions about this video, please post them in the comments below or send me an email at askjohn@movesmartly.com.